Hello again, everyone. This is Joe, and in this technical analysis of the stock market video weekend update, we're going to take a look at the S&P 500 daily and weekly charts, the VIX, and then we're going to check in on the long-term Dow monthly charts and spend a few minutes on those, so stay tuned. Okay, so now let's take a look here. Here's what happened on Friday. The Dow was down 5.36 points, and look at this big range that occurred. That all happened when Michael Flynn, the news came out that Michael Flynn pleaded guilty to lying to the FBI. And of course, then the speculation was, what else does he know? What is he going to know and hurt Trump with? And so the market really fell out of bed, but then recovered in the afternoon. So it's going to be seen how this thing plays out over the next few days and weeks. That's the picture on the daily chart. I've got minute wave 5, minor wave 5 labeled up here. And of course, if we have minor wave 5, then that means intermediate wave 5. And if intermediate wave 5 is complete, then that means that the whole cycle is complete in the move up from March of 2009. And I think there's a very good probability that if we are not there with the move on Thursday, we are very, very close. Let's take a look at the weekly chart. And here's the weekly chart, weekly view. I drew a little channel in here. We're inside the longer term channel of all of the trading, since 2009. Okay. We're within that. And then within that, if you draw a trend line here with the lows of 2016 and this low here of November 2016. What was this? This was February. No, this was July. Draw a parallel line and launch it up here from the top of minor wave 3. You can see this is where we're bumping into it right now in terms of our move. And I really do believe that, this is the minor wave count that we've got. This wave 1 here, and then we had this kind of a flat, almost expanded looking flat wave 2. Then this wave 3, kind of a sharp pullback wave 4, and then this push that we've got here in wave 5. So that's what we're looking at. That's the wave count. And of course, here is wave 4, and so the intermediate wave 5 would be complete there also. Let's take a look at the, I got to go back to my mouse. Let's get the VIX. This is a chart that I showed last week, long-term, a weekly chart of the VIX. And I did not touch this trend line. This is trend line I drew last week. It's really interesting how the explosion that happened Thursday, Friday, primarily on Friday, came right up to that trend line that backed off. So this just looks like a huge compression that's going on to me. And it just seems like it is setting up for a major volcanic eruption. You can see the kind of eruptions that occur once you start getting, very compressed activity going on. It's happened over time, no matter where you look. And shouldn't be surprising because things go in cycles. I think the thing that's surprising is how long this is stretched out in such low VIX readings in here, but nothing goes on forever. And with this kind of pattern that's forming, you better watch out. It's like a major flag that's warning right now. All right, now I want to take a look at the long-term Dow picture. This is my Elliott wave count of the long term. This is the monthly chart of the Dow Industrials from 1900 to present day. Okay. And the wave count I've got is that we are in super cycle wave 5 from the low of June 1932. And we are in the 5th cycle wave with 1, 2, 3, 4, and the 5th cycle wave right now. And the other thing that I'm noting on here is Professor Shiller's cyclically adjusted price earnings ratio, called the CAPE, cyclically adjusted price earnings ratio. I have posted about this numerous times in the past. It has gotten very elevated now. But here's what I want to point out, a couple of things. Look at these lows, okay? Here's a cycle wave 4 low in here. In December of 1920, we got to a CAPE ratio of 4.78, and that was just prior to the bottom of cycle wave 4. of super cycle wave 3, which peaked in 1929. Okay, then we get the major sell-off, this huge collapse that occurred in super cycle wave 4, and we get a reading that's almost to that same level. Now, there is no other reading that's this low until you get to the end of cycle wave 4 in August of 1982, July, August 1982, 6.64. These are the three lowest readings since in all of Professor Scholar's data, which he goes back to 1871, by the way. I've only got pictures right here to 1900. So these are the three lowest readings. I find it very interesting that they coincide exactly with wave 4, and super cycle wave 4. Okay, and so now what we're looking at in terms of the red squares, what I've got is what I've highlighted is the extreme readings that we're getting when the CAPE ratio has been over 31, which is exactly where it is right now for the months of October and November. Now, I'm going to make a note that these are preliminary because not all of the data is final yet, but this is what he has posted on his website in terms of the current readings. They are above 31, and there are only two other times where there are periods of times where that happened. 1929 at the top in here, August, September 1929. I'm going to zoom in real quick and show you what I'm talking about. Right here, these 2 months, right here, August and September of 1929 had CAPE ratios that got to like 32.5, something like that. Both of those readings were over 31, and then that was it. Now, we had this extreme, literally is almost like an extreme of multi-centuries that occurred in the huge push that occurred in wave 3 of cycle wave 5 of super cycle wave 5. It's like this is a huge blow-off. And the monetary easing and the everything that's occurred since 1982 has been just incredible. And of course, since the financial crisis of 2007 to 2009, it got even more magnified in terms of what the money flow and everything. You've heard all of that at this point. Let me zoom in on this just so you know what I'm talking about. So it got above 31. The CAPE ratio got above 31 starting with June of 1997, and it didn't stop until September of 2001 with the 9/11 incident that happened, the terrorist attack that happened in September of 2001. And after that month, then the readings dropped below it, and then it continued to ease off. And then now here we are, October, November 2017, we now have the first readings back above 31. So we are at an extreme. I feel like the clock is ticking. I mean, they talk about doomsday clocks for nuclear. To me, this is a doomsday clock on the economy that's ticking very, very close to midnight. We're just not going to get this kind of room and this kind of exposure that we had at the huge internet bubble that occurred. And now we're getting the same kind of readings that we did at the top in 1929. It's sending the same kind of message. So it's just something that we really need to be paying attention to. Of course, we have to be paying attention to price, and we're watching price. We're watching to see, when does the market really start to break down? My point is it can happen at any time. And when you look at stock market history, stock market peaks have occurred at seems like almost any month in the year. Okay, in 1966, they peaked in January. It was either January or February. Okay, was the top. In 1968, before a huge decline of 33%, they peaked the week ending November 30th, and they sold off. Okay, and in 1973 they peaked in February 1973. It was January 5th, 1973. That was the 8th week above 1,000. First time that punched above 1,000 in the history of the Dow Jones Industrial Average, and they had spent 8 weeks above 1,000, and then that was it. And it collapsed 45% in 11 months. So, there's no guarantees. It can peak at any time in any month. And, here we are, moving into December. We got January right on the horizon. And if we take a look and look at the weekly chart here on the S&P 500, of course, the high close here, the week ending December 1st. So we'll watch and see, do we get some continued movement, continued push to the upside further, or does this start to struggle and then roll over and turn down? So the whole point is we are at extremes that we should be paying very close attention to. All right, that's the picture for now. Now you know what's going on. Now you know the long-term picture. You know where we sit in the grand scheme of things from a long-term perspective. Oh, there is one other thing I wanted to show you. I showed you this chart, and this kind of puts everything in perspective, right? It shows you how dynamic and how big the moves really occurred. This is a logarithmic chart. This keeps everything in percentage in proportion. So 1 inch move down here equals a 1 inch move up here percentage-wise, okay? But if you want to look at an arithmetic chart, here's how the activity of the Dow Industrials look now. So now look at 1929 and the huge collapse and calamity that happened before World War II. And now here we are, and we're literally going ballistic. I mean, going straight up like a rocket launch. That kind of activity just doesn't continue. So again, the whole point of this video is to make you aware of what's going on, and so that you start to watch and start to put your guard up a little bit and start looking at, how to protect yourself and how to think about how you can play the market. If you only play the market to one way, how can you play the market to the downside also? All right, that's it for this weekend. Long video. Hope you found it helpful. If you did, please give me a thumbs up on the video and share the video with other people. Share the video with people you care about. And I guess that's about it. Oh, I do want you to head on over to the website. If you're not watching this on my website, head on over to the website, check it out. And if you'd love to see free market updates a little more frequently, sign up to get those. Just your first name and email, and you're good to go. All right, that's it for today. Everyone have a great week. We'll talk to you on the next video.